Welcome to the Chapter 34 lecture about the open economy. This chapter focuses on the key concepts related to international trade. Openness to international trade has clear benefits. Trade allows people to produce what they produce best. Trade results in a greater variety of goods and services. Economists use the term open economy to describe an economy that interacts freely with other economies around the world. In this chapter, we will discuss imports, exports, trade balances, and exchange rates. The international flow of goods and services interaction between economies occurs in two ways. One, goods and services in the product market, or two, capital assets in financial markets. We will start with the flow of goods. A few key terms to get us started. Exports are domestically produced goods and services sold abroad. Imports are foreign-produced goods and services that are sold domestically. Net exports, or the trade balance, is the difference between the value of exports and imports. A simple math equation for net exports is NX equals E minus I. A trade surplus occurs when net exports are positive, and a trade deficit occurs when net exports are negative. The second way interaction occurs between economies is the flow of financial resources. The key term in this market is net capital outflow. Net capital outflow, or NCO, is the difference between the purchase of a foreign asset by a domestic resident and the purchase of domestic assets by foreigners. An example of NCO would be a U.S. resident buys stock in Toyota and a Japanese resident buys a U.S. government bond. NCO has two forms: foreign direct investment, such as McDonald's opening up in Russia, or foreign portfolio investment, such as an American buys stock in a Russian company. When NCO is positive, capital is flowing out of the country. Domestic residents are buying more foreign assets than foreigners are buying of domestic assets. When NCO is negative, capital is flowing into the country. Domestic residents are buying less foreign assets than foreigners are buying domestic assets. Equality of net exports and net capital outflow. Net capital outflow must equal net exports. NCO equals NX. This equation holds true because every transaction that affects one side affects the other side by exactly the same amount. For example, Walmart buys 50 million in clothing from China and sells it to American consumers. China uses the 50 million to buy U.S. government bonds or uses 50 million to buy Boeing aircraft. The amount of net exports is the same as the amount of net capital outflow. There are two possible outcomes: a trade surplus and positive net capital outflow. If NX is greater than 0, domestic residents have a surplus of foreign currency and use it to purchase foreign assets. Therefore, capital flows out of the country, NCO greater than 0. Or a trade deficit and negative net capital outflow. If NX is less than 0, domestic residents finance purchases by selling assets abroad. Therefore, capital flows into the country, NCO less than 0. Let's turn our attention to exchange rates. The nominal exchange rate is the rate at which a person can trade the currency of one country for the currency of another. Rates can be expressed in two ways: euro per dollar or dollar per euro. We will always use foreign currency per dollar. Appreciation means that the exchange rate changes so that a dollar buys more foreign currency. For example, 80 yen per dollar changes to 90 yen per dollar. Depreciation means that the exchange rate changes so that a dollar buys less foreign currency. For example, 80 yen per dollar changes to 70 yen per dollar. The real exchange rate is the rate at which a person can trade goods and services of one country for the goods and services of another. Real exchange rates depend on nominal rates and the price of goods and services. The real exchange rate equals the nominal exchange rate times domestic price divided by the foreign price. The real exchange rates are a factor to determine the amount of exports and imports. Depreciation of U.S. real exchange rates caused U.S. goods to become relatively cheaper than foreign goods, which means that exports increase and imports decrease. Therefore, net exports increase. Appreciation of U.S. real exchange rates caused U.S. goods to become relatively more expensive than foreign goods, which means that exports decrease and imports increase. Therefore, net exports decrease. This is the end of the Chapter 34 lecture about the open economy. If you have any questions about this material, please post a question and ask Professor Bakula or send me an email.